Welcome to this special update. In this video, we cover two notable events at the Federal Reserve that happened close together: the passing of former Fed Chair Alan Greenspan and the first meeting led by the Fed's new chair, Kevin Warsh. These two events give us a chance to look at how the Fed has changed over the years, what new leadership might mean going forward, and why any of this matters to everyday investors. To start, it helps to look at the Fed's history and put its leadership in context. The U.S. economy has grown through many different Fed chairs, appointed by presidents from both political parties. Each leader faced their own set of challenges and helped shape the way future leaders would manage the economy. During much of Greenspan's long time in charge, the Fed did not even publicly announce its decisions about interest rates. Interest rates are the cost of borrowing money, and the Fed adjusts them to help keep the economy on track. Back then, markets had to figure out what the Fed had decided by watching how short-term rates moved. It was not until 1994 that Greenspan began issuing a written statement when rates changed, and even those early statements were short and often hard to interpret on purpose. The tools we now think of as standard at the Fed, such as regular press conferences, detailed economic forecasts, and guidance about future plans, were introduced under Ben Bernanke, Janet Yellen, and Jerome Powell, usually in response to major economic crises. The main point here is the Fed changes over time and does not run the economy by itself. Deeper forces like new technology and shifts in population have a much bigger effect. The economy has kept growing over long periods, even as the Fed's approach has shifted quite a bit. Now, let's look at what has already started to change under Kevin Warsh, who led his first Fed meeting in June. Warsh had said that the Fed's communications have become too complicated and too focused on predicting the future. At his first meeting, he made the Fed's official statement much shorter, took out any language that suggested where rates might be headed next, and chose not to submit his own economic forecasts to the Fed's shared projections report. He also announced 5 working groups to look at different parts of how the Fed operates. These groups will focus on communications, data, the approach to managing inflation, the Fed's balance sheet, and the effects of artificial intelligence and technology. The last area is worth paying attention to for long-term investors. As this chart shows, growth in worker productivity, which measures how much output is produced per hour of work, has varied quite a bit across different decades. There was a clear boost during the technology-driven growth of the 1990s. If artificial intelligence leads to similar gains in productivity, it could support stronger economic growth and help keep inflation lower over time. This is not a sure thing, and it is very hard to measure in real time. But even small, steady improvements in productivity can add up to meaningful economic gains over many years. In the shorter term, the Fed is still dealing with a difficult environment. Uncertainty around energy prices and inflation means the committee is split, with roughly half of members expecting rates to stay where they are through the end of the year, and the other half expecting them to go higher. Finally, interest rates are not the only lever the Fed can pull. Its balance sheet matters just as much. The balance sheet is essentially a record of all the assets, mainly bonds, that the Fed has purchased over the years to support the economy and financial system. As this chart shows, the Fed's balance sheet was under $1 trillion before the 2008 financial crisis. It then grew sharply as the Fed bought bonds to help steady the financial system during that period. Today, the balance sheet sits at $6.7 trillion, down from a peak of nearly $9 trillion in 2022. Warsh supported those emergency purchases at the time, but has argued that the Fed was too slow to pull back once conditions had stabilized. The broader point for investors is that the Fed's approach is never set in stone. It has always adapted based on economic conditions, new research, and the priorities of whoever is leading it. Less forward guidance from the Fed may mean fewer signals about where policy is headed, and that could bring more uncertainty about how the Fed will react to new developments. For long-term investors, what matters most is not any single policy decision, but the bigger trend shaping the economy over time. Many of these trends remain positive today. Staying invested with a well-built portfolio and a clear financial plan is still the most dependable way to work toward long-term goals. We hope you found these insights helpful. If you would like to learn more about any of these topics, please don't hesitate to reach out. We look forward to speaking with you.